Welcome, friends. In this edition of live virtual revisionary classes, I, CA Ashish Gupta, Joint Director, Board of Studies, welcomes you all. Of course, student, you must be waiting for CA Jagbandhu sir because he is should it is he is required to take the session today, and of course he will take the session today. Don't worry. But before that, there is one announcement for you all. Students, we are coming out with an induction program, or we can say it is a kind of an induction for the CA Foundation student. Okay, so because and it is scheduled for 23rd May and from 10 a.m. onwards, and I think it will be up to 1:30 p.m. So in this program, the main focus will be on ICAI and its structure, because when a student is entering in the CA foundation, he must be, first of all, he must be aware about what is ICAI. Then next will be how to avail various services of ICAI. Then opportunities available during CA journey and after you qualify CA. Then various academic initiative you should avail. Meet the superheroes of the profession. So these are very attraction of this induction program, which is scheduled to be held tomorrow. That will be through live virtual mode. Of course, if you go to the BUS site, ICA BUS site, there is a pop up there, and there everything is available there. Even QR code is there. स्टूडेंट्स, आज आज की जो क्लास है वह लाइव वर्चुअल रिवीजन क्लास, उसमें सीए जगबंधु सर क्लास लेंगे। पर इससे पहले एक छोटी सी अनाउंसमेंट करना चाह रहा था मैं। तो आपके घर में या आपके भाई बहन या आपके रिलेटिव्स या आपके दोस्त, जो भी सीए, जिस बच्चे ने सीए फाउंडेशन ज्वाइन किया है, उसके लिए यह एक मौका है, या सीए फाउंडेशन ज्वाइन करने जा रहा है, उसके लिए यह एक मौका है। एक इंडक्शन प्रोग्राम हम करने जा रहे हैं जो कि कल होगा 10 बजे। तो आप बीयूएस के साइट पर जाएंगे, उसके बारे में सारी डिटेल है कि आईसीआई क्या है, इसका स्ट्रक्चर क्या है, और क्या क्या बेनिफिट्स आईसीआई की वेरियस सर्विसेज से मिल सकते हैं आपको, और क्या क्या अपॉर्चुनिटीज हैं सीए के दरमियान, पढ़ाई के दौरान और उसके क्वालिफाई करने के बाद। और उसके अलावा हम ये भी बताएंगे कि बीयूएस एकेडमिक्स ने क्या क्या इनिशिएटिव लेती है। तो ये सब चीजें और अपने इवन उनके पास मौका रहेगा सुपर हीरो से मिलने का। तो आप लोग इस अपॉर्चुनिटी को ना छोड़ें, और अपने यार दोस्त और या जो भी आपके मित्र या रिश्तेदार हैं, जो बच्चे सीए ज्वाइन करना चाह रहे हैं या सीए फाउंडेशन ज्वाइन कर चुके हैं, आप उनको ये जरूर बताइए। स्टूडेंट्स, सो माय रिक्वेस्ट टू यू, प्लीज inform your all friends or your relatives who are CA aspirant and who have joined the ICI CA Foundation course to interact with ICI and to know about the ICI. For this purpose, we will play a very small promotional video. Then after that, CA Jagbandhu sir will take up the session. Mr. Ajit, please play the video.
Yes, sir. Thank you, sir.
Thank you. Jagbandhu sir, please start the session now.
Okay. One dear students, I welcome you all to this revisionary session of CA Final Advanced Financial Management, in which we are going to discuss about the topic of security evaluation today, and followed by the beginning of portfolio management. So let me just quickly take you through the concepts of security valuation, which we have already covered in our regular sessions. So, security valuation, the entire chapter, I can just break it into two parts, wherein initially we had the valuation for equity shares, and in the second stage, we have discussed about the valuation for the bonds or debentures. Okay. So, let's discuss about first why do we need to undertake a valuation of it? Because we want to know the fair value of the security, fair value of the share, right? So once we know the fair value of the share, we are in a position to decide whether the share is overvalued or undervalued. And if we find that a particular asset or the share is undervalued, we are going to buy it. And if a particular share is overvalued, then we are going to sell it. Okay. So fair value is something which is going to be compared with the market price, and based on that, we take a decision whether the particular asset is to be purchased or not. Now, to do that, we are going to cover some return concepts. We're going to look at what are the valuation of equity shares model. Then we have valuation of preference shares, valuation of bonds. In that also, we are going to cover the value of bonds and bond duration or the Macaulay duration or modified duration. Then coming to the return concept. Return concept is basically the required rate of return that an investor requires. This is the opportunity cost of capital. Discount rate is the rate which we use to calculate the present value of the future cash flows, which will depend on the risk of the cash flow. Higher the risk, we are definitely going to discount the cash flows at a higher rate. Right? So, for example, if you have cash flows coming in at different years, the cash flow which is coming at the later years is supposed to be more risky, and this is going to be discounted at a higher rate. We've also learned something called as internal rate of return in CA income capital budgeting, which is basically the rate of return earned by an investor from an asset by investing today and realizing the sale price or return from it. The required return on equity is a very popular model that we have already covered in CA income and also in CA final level. So CAPM, which is capital asset pricing model, wherein we calculate KE as the cost of equity, the required return by the equity shareholders as risk-free plus beta
Pradhu sir,
into RM
Pradhu
minus
sir,
RF. Yes.
there is a disturbance in your voice, little bit.
One second. I think there is some fan issue. Just give me a minute. Okay. I think this should be good. Okay.
Now it's okay.
Now it's okay. So there was a fan rotating, so probably the sound of the fan was okay. Anyway, so guys, coming to the return on equity, CAPM, which is a required return by the equity shareholder depending on the risk of the equity shares. That's RF plus beta into RM minus RF, where beta is the measure of the systematic risk and RM is the market rate of return, which is the rate of return on the market portfolio. And risk-free is the risk-free rate on, the rate on the risk-free securities. More about it we'll be discussing in the chapter of portfolio management. So that's the way various returns that we were discussing. Then coming to valuation of equity shares. So how do we go about valuation of equity shares? First up, if your target is to hold the equity share for just 1 year, so of course the cash flow that you're expecting from that particular share from that particular model is one dividend at the end of the year and price at the end of the year. So D1 and P1, these are the two cash flows that are expected. Cost of equity is 12%. And then the value of share, we can determine it as D1 plus P1 upon 1 plus K. Okay, this is where we are just simply taking the present value of all the future cash flow. When we have no growth, then it's the same dividend occurring every year. And when we discount it back to the current level, by simply using the geometric progression, this is what we have already covered in the regular sessions. I'm not going into the derivation part, but if it's a constant amount of dividend, then the formula is going to be dividend upon K. Whereas if there is a growth that is happening in the value of the, amount of the dividend till perpetuity, a constant rate of growth, then we can use the Gordon model, which is giving us D1 upon K minus G. But this particular model, D1 upon K minus G, suffers from a limitation, or there is some problem in this particular model. Yeah. So when we say that there is some problem in this particular model, can you tell me what's the limitation of this model? Anyone guess? Can anyone of you tell me what's the limitation of this model? What limitation can you see for this model? Anyone guys? What's the limitation of this model?
Cost of capital is constant.
No. Not. Anyways, cost of capital is supposed to be constant, but one problem with this mathematical model is since the denominator is k minus g, it doesn't allow to assume a growth rate to be more than the cost of equity. Because once you, if your growth rate is more than cost of equity, the denominator will be negative, and which will essentially make the value of share to be negative, which is absurd, right? So therefore, we thought how to remove this particular limitation. So we just thought, how do we work about, removing this limitation? So we thought about, is it really possible to have a high rate of growth till perpetuity? Like, can the company really attain a super growth rate for its entire life? So then the answer came out to be absolutely not, because much of the companies that we observe in real market scenario, they attain a high growth rate during the initial phases. Later on, the rate just stabilizes to a particular smaller level of it, right? So therefore, we went ahead with two-stage dividend discount model. In two-stage dividend discount model, we say that the growth rate is going to be high, or you're going to have a super growth rate for initial few years, and then later on it will stabilize to a lower growth rate, right? So growth rate is like 20% for 3 years, and then 10% from year 4 onwards, and cost of equity remaining same. So here what we do is we first take the present value of all the dividends that are happening from year 4 onwards. So I get the value of the share in year 3. I get the value of the share in year 3, which is D4 upon K minus G, right? So that's fourth year dividend upon K minus G. The fourth year dividend was 19, taking into account the growth factors. And we take the value of the share as on year 3 as taking the dividend of fourth year upon K minus G. This is the terminal value of the share in year 3. But when we are going to buy the share today, we are not only entitled to this terminal value, but we are also entitled to 3 years dividend. Right? So that's where we derive the value to be, D1 upon 1 plus K plus D2 upon 1 plus K square, which is discounting the second year dividend by 2 years, discounting the third year dividend by 3 years, discounting the fourth year value by 3 years. And that's how we derive at this particular value of 710. Right? So this is a two-stage dividend discount model, right? Then we have certain earnings-based model. The earnings-based model, as we can say, since we had a Gordon formula of D1 upon K minus G, we have seen that it is D1 can be determined as first year EPS into dividend payout ratio divided by K minus G. First year EPS into dividend payout ratio divided by K minus G. So P0 is EPS into 1 minus B, which is dividend payout ratio, is 1 minus retention ratio. That's 1 minus retention ratio upon K minus G. Essentially, B, which is retention ratio, we have already covered this in CA Inter also, that growth rate can be computed as retention ratio into return on investment, or a rate of return on investment, right? That's the Gordon model, and is the rate of growth. Then we had the Walter model also, which was already covered in CA Inter dividend decisions, which is again taking the present value of the future dividends, but it takes a different approach. And that's computed as dividend plus earnings minus dividend into R upon K, the whole divided by K. Multiplier approach, wherein we take the P ratio. The P ratio is simply MPS upon EPS. Now, how are we going to really use this? So we use a comparative method. So we look at the P ratio of similar comparable companies. So XYZ, 3 companies, EPS, their EPS is 2, 4, and 2.5. MPS is 25, 44, and 30. So what we find is that X is having a P ratio of 12.5, Y is having a P ratio of 11, and Z is having a P ratio of 12. So a P ratio, average P that we get for all 3 companies is 12.5 plus 11 plus 12. So the average of this P sector of this entire comparable companies is 11.8. So if you find that one of our companies that we want to value is having a EPS of 3.5, we can simply say that it's going to be 3.5 into 11.83. That's going to be 41.41 as the value of the share using the multiplier approach. Okay. Apart from that, just like we wanted to undertake the value of the share using present value, we also had free cash flow to the firm model. We have based on EBIT. We have also covered based on EBITDA, based on cash flows, free cash flow for the firm, and also free cash flow for the equity. Okay. So free cash flow for the firm, we can calculate it as starting with net income, wherein we add the post-tax interest expense, also add back the depreciation, because this is a finance expense and this is a non-cash item. And then we adjust the capital expenditure and working capital expenditure. I mean, working capital. Right. So if your capital expenditure has increased, that's going to be a subtraction. If your working capital has increased, that's an outflow that will be subtracted. You compute the FCFF either based on net income, or you calculate it on the basis of EBIT. Right. So you start with EBIT, make it post-tax by doing EBIT into 1 minus T, add back depreciation, adjust the capital and the working capital. Same way in case of EBITDA. Right. So in case of EBITDA, since it is earnings before interest, depreciation, tax, and amortization, so that's 1 minus T, and then you adjust the tax saving on depreciation. Right. So we are not adding the depreciation as such; we are adding the depreciation the tax saving. And then add less capital expenditure, add less the changes in non-cash working capital. Based on cash flow statement, you can start with cash flow from operations, make it after tax by adding the interest into 1 minus T, and then adjust the capital expenditure. Same way, finally, we get the free cash flow for equity, since we want to value the equity shares. That's going to be FCFF minus the interest payment and minus the principal paid, minus preference dividend, and also any new debt that is raised. Okay, that's the free cash flow for the equity calculation. Now let us do some questions, or before that, wait. We'll do a 3-stage cash flow model, EV EBITDA discussion, and then we will go for the bond wala part. Okay, 3-stage cash flow. So sometimes what we observe is that the growth rate in 2-stage model, the disadvantage of that was like, there was a sudden drop in the growth rate, but in real life, it's not going to be like that, because the growth rate cannot be dropping suddenly like this. You're maintaining a 30% high growth rate and then suddenly it falls to 10%. That's not going to happen. So ideally, what should be the case is that the growth rate falls in a gradual manner, right? So in such situation, we can have like an example, growth rate of 30% for 4 years, and then from year 9 onwards, 10%. So every year there's going to be a gradual fall in the growth rate. So high growth minus slow growth, we can say 30% minus 10%, which is 4%. And then we have this divided by the number of years then. So high growth minus slow growth, which is 30% minus 10% upon the years of high growth and slow growth. So 4% is the adjustment rate that we are going to undertake every year. So like for initial 4 years, you have high growth, and then later on it is falling gradually by 4% every year till it reaches the level of 10th year, which is 10%. Okay, then we apply the same growth rate numbers to calculate the dividend, take the PV of them, and then take the total of it. Then another concept is enterprise value. The enterprise value is basically the value of the business of an organization. We determine the value of an enterprise by simply multiplying the market value of all shares. Market value of all shares, we add to it the market value of all debt, and we are going to remove any cash. One popular multiple that is used in enterprise value calculation is EV EBITDA multiple. So EV EBITDA is enterprise value to EBITDA. So EV multiples are compared to measure performance of enterprises, EV to sales, or it may be even EV to EBITDA. For example, there's a company with EV to EBITDA as 10, and there's another company with EV to EBITDA 15. Okay, there's a company with EV to EBITDA 10 and EV to EBITDA 15. So when we say 10 as EV to EBITDA multiple, it is for 1 rupee of EBITDA, 10 is the enterprise value. And when it comes to 15, for 1 rupee of EBITDA, 15 is the enterprise value. Okay, so this is a popular model that we use in enterprise value model. Now, let us just go to the assignment questions that we have so that we can discuss them in detail. Let's consider question number 3, guys. Let's consider question number 3. Let's go through that question. Concept analysis.
जगबंधु जी,
One second, sir. कुछ ये internet का issue, just changing the.
Okay. आप एक काम कर सकते हैं, नहीं तो विदाउट कैमरा कर दीजिए चालू.
ओके, ठीक है. आई थिंक स्क्रीन विजिबल है.
हाँ, स्क्रीन विजिबल है
ना? अच्छा. Okay, so guys, we're looking at this question number 3, which is share of beta limited is being quoted at a price to earning ratio of 10 times. In the coming year, the company is expected to retain rupees 10 per share, which is expected to retain 10 per share, which is 45% of its earnings per share. Okay. So you are required to evaluate cost of equity to the company if the market expects a growth rate of 10%. And if the anticipated growth rate is 12%, what will be the indicative market price with the same cost of capital? Okay. So here we can simply, I think now the internet is back. Yeah. The share of beta is being quoted at a P ratio of 10. And we are expecting the company to retain 10 per share, which is 45% of its earnings per share. And we are required to evaluate the cost of equity to the company. The market is expecting a growth rate of 10%. Anticipated growth rate, if it is 12%, what will be the indicative market price? So we come back over here. That's question number 3 that we are doing right now. Okay, the P ratio is 10. P is given to be 10 times. Then in the coming year, the company is expected to retain rupees 10 share. So retained earnings is 10 per share. Retained earnings is 10 per share, which is 45% of its earning. The retention proportion is 45%. Okay. So you're required to evaluate the cost of equity if the market expects a growth rate to be 10%. Now, this is first case where the growth rate is given to be 10%. Now, we are pretty sure that when we have the growth rate given to us, the only way by which we can obtain the value of the share is, which is P0. We can do it as D1 upon K minus G. Now, here we know that growth rate is 10%, right? Growth rate is given to be 10%. What we need is the value of K and the D1 or the first year dividend, right? So let me just keep this formula aside and let me work on the part of calculating D1. Okay, calculating D1 and K specifically. So in case A, we need to get the value of K. Right? So K is simply, we know the formula of K as one of the formula is EPS upon MPS. So K is EPS upon MPS, right? If it is EPS upon MPS, we can definitely say that it is 1 upon P ratio, right? Because, or I can say like this, it's 1 upon MPS upon EPS. Okay. K is 1 upon MPS upon EPS. So finally, we can say K is 1 upon P ratio. So once we have the P ratio given to us to be 10 times, I can definitely say that the K is going to be 1 divided by 10, which is 10%. So cost of equity stands as 10%. And so K is 10%. So in this formula, we got the value of K. And we already know the growth rate as 10%. Now coming to D1. What should be the D1? So retained earnings is going to be 10 per share. So in the coming year, the question is clearly saying that in the coming year, if the company is going to retain rupees 10 per share, which is 45% of earnings, then we can definitely get from here what will be the value of EPS for the first year. EPS for the first year will be retained earnings divided by retention ratio. Because we have the retained earnings number. Okay, so retained earnings is 10 upon 45%. So the EPS stands as 22.22. Now, of course, from this, we can surely get the value of, EPS 1 equal to 10 upon 45%. So DPS for the first year is going to be EPS for first year minus retention for the first year. Right? So EPS for first year is 22.22 minus retention stands as 10. We can get this as 12.22. So dividend per share is 12.22. Right? So that comes out to be the dividend number. So now in our formula, we already know that it's D1 upon. So D1 is 12.22 upon K is 10% minus a growth rate of 10%. So
सर D1 में growth rate ऐड होना चाहिए ना?
D1 is already given in the coming year. So this 10 per share retention is for the next year. So this is for the next year. We cannot take that as D0, right? It's obviously going to be the D1 number.
And सर ये जो आपने EPS निकाला है तो हम ये जो EPS और PE रेशो दिया हुआ है तो K उसके अकॉर्डिंग भी निकाल सकते हैं क्योंकि यहाँ पे तो
EPS
0 आ जाएगा वैल्यू.
EPS and PE ratio.
हाँ
I didn't get what you're saying.
आपका PE रेशो है EPS में तो MPS निकल जाएगा और
MPS निकल
उसके
जाएगा.
बाद में
Perfect.
हाँ और
Yes.
KE हम EPS डिवाइड बाय MPS करके निकाल सकते हैं.
EPS divided by MPS
यहाँ पे जो
KE, or we are talking of, we want to compute the cost of equity, right? So I have taken this mistake. We got the DPS or D1 as 12.22. Now with this PE ratio, since P is equal to 10 times, we are asked to compute the cost of equity, right? Okay, so I was going for calculating the price because price will be definitely negative then. I mean, coming out to be not available. So P ratio, since it is 10 times, right? P ratio, since it is 10 times, and we already have the EPS number computed, which is 22.22. We can get the market price per share. Market price per share is going to be P ratio multiplied by EPS is 10 multiplied by 22.22. Right, so that's 222.2. That's the market price per share. Or market price per share is nothing but P0. We can get the cost of equity to be D1 upon P0, adding the growth to it. Right, adding growth to it, we can get D1 as 12.22 divided by the market price per share is 222.2, and then plus the growth rate is 10%. So essentially this is going to be 15.50. 15.50%. Then the second case is where the growth rate, case B, the growth rate is given to be 12%. If the growth rate is given to be 12%, again applying the same thing, the EPS, PE and MPS, they are anyways going to be same. The only thing changing is the KE numbers. The only thing that is changing is the KE numbers. K is D1 upon P0 plus G. So that's going to be 12.22 upon 222.2 and add to it 0.12.
$17.50.
0.12. That's 17.50. 17.50. Did we get it, guys?
सर अब आप एक बार सॉल्यूशन का पूरा वो दिखा सकते हैं?
Yeah. Want to take a screenshot? You can take it.
Yeah, thank you, sir.
Done? Okay. Then coming to question number 5, guys. Read this question number 5, guys. You have to compute the value of one equity share. Yeah, we have which is before tax of 8,000 crores. Equity share capital of the company is 19,000 crores. Number of equity shares is 380 crores. Okay. Long run growth rate of the company is given to be 7%. Risk-free rate of return is 9.5%. Beta of company is 0.1. Market risk premium is 3.1%. Total capital expenditure is 20,140 crores. Chargeable depreciation is 17,100 crores. Total increase in working capital is 1755.60. And the new debt to be issued for funding is 2062.108 crores. Tax rate is 30%. So we are supposed to calculate the value of one equity share. Now, can you tell me which approach should we use to calculate the value of equity share over here? Can we use the dividend discount model? If dividend discount model, then is it going to be like constant dividend growth, or is it some other different model?
CAPM.
CAPM will be the rate for at which we are going to discount it. So let's try to get that answer first. Question 5. For CAPM, we definitely have to calculate the cost of equity, right? We say cost of equity will be RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF is 9.5%, right? So RF is 9.5% plus beta is 0.1 into RM minus RF. Market risk premium is 3.1%. 3.1% into 0.1. So we definitely get the cost of equity as 9.5% plus 0.1 into 3.1%, which is 9.50%. Or one second, problem. 0.1 into 3.1%. 0.1. So that's 9.81%. This is what we got cost of equity. Then how do we go about calculating the value of equity? How do we go about value of equity? How do we go about calculating the value of equity? We can calculate the value of equity using two approaches. Value of equity, of course, we have to calculate using FCFE approach, free cash flow for equity. We need to first get the FCFE, free cash flow for equity. Free cash flow for equity. Now, how do we go about calculating the free cash flow for equity? We have the profit for the company, which is 8,000 crores, which is a before tax number, right? So we have to make it as after tax profit for the company. So we start with making it a after tax figure, and then go about calculating and adding and subtracting few items. And so how do we calculate the FCFE? We start with profit after tax. From that, we are going to subtract capital expenditure. We add back depreciation. And again, when we look at this working capital is increasing, guys. Because as the working capital is increasing, we're going to add working capital increase plus new debt, because once you're issuing any new debt, that's a cash inflow for you. And we are going to subtract debt repayment. Okay, so add new debt less any debt repayment, and then to that we are going to definitely take the effect of any preference dividend or preference effect if it's there. There's no effect of preference dividend, but still we will count on that. So we'll say PAT less capital expenditure plus depreciation plus working capital increase plus new debt minus any debt repayment, and also we are going to adjust the preference share. So we will say add new preference share issue, right? New preference share issue, and then we are going to subtract the preference rate, right? So using this formula, can you guys calculate the FCFE value? All the numbers are there over here. We just need to put them and give me the value of FCFE. Can you calculate the FCFE value? First, you write down this formula quickly. Write down this formula quickly. Yep. Okay, so I hope you would have taken down the formula. Taken down the formula. Now, just substitute these numbers and try to get the value of it. Try to get the value of the equity, value of the FCFE. Yeah, try to get the value of FCFE, guys. Yep, calculate the value of FCFE. Are you able to get it? So when we're doing the calculation of FCFE,
6,377.
6,377.
0.708.
Okay. 0.708.
0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.708. 0.
Okay. So we start with PAT. So how much is PAT? Profit of the company before tax, it is 8,000 and the tax rate is 30%. This is going to be first up 8,000 into 1 minus 0.3. From that, we will subtract capital expenditure. So capital expenditure is 20,140 minus 20,140. Right. Add back the depreciation. We have the chargeable depreciation as 17,100. 17,100 is the depreciation that's added back. Then add back any increase in working capital. So we have the working capital, which is 1755.60. So I need to add 1755.60, which is the addition of increase in working capital, right? Then to that, there's going to be new debt. New debt to be issued for funding is 2062.108. We'll add 2062.108 less any debt repayment. So any sort of debt repayment happening? No, doesn't seem to be. Is there any sort of preference dividend or preference share being issued? No, doesn't seem to be there's anything. So we can simply use this formula. As 6377.71. Right? Is this the FCFE that we are getting? Everyone?
Yes, sir.
One second, there's a problem. 17,100 chargeable depreciation will be added back. Okay, increase in working capital. So since there's an increase in working capital, your cash outflow is 1755.60. That's going to be a cash outflow. And also new debt that will be raised. So 2062 will be definitely added. Okay, so this will be a bit of, yeah, this should be the correct answer because we have, added the working capital increase. Rather, it should not be an increase because when there is an increase in working capital, we are supposed to be paying. I mean, there's going to be a cash outflow. There's going to be a cash outflow. Okay. So that's the FCFE. Yes, Abrakesh ji.
Good morning, sir. Sir, my question is regarding the cost of capital, cost of equity calculation. Why RM minus RF has been taken as 3.1%? Because it is a RM actually.
No, it's a market risk premium. When you say market risk premium, it is the RM minus RF, the extra return that you get in the market.
So straight away that will be the answer.
That's RM minus RF. Yes, that's straight away RM minus RF.
Okay.
Had it been, had it been only market return, then we would have taken it as RM.
Okay. And which formula, I mean, model we call this FCFE? I mean, when we write the answer, we should start with which formula we are using.
Depending on the data that is given in the question. So in the question over here, we have profit after tax numbers. I mean, profit numbers, we have to start with profit. Had the given question given you cash flow approach, then you would have used the cash flow method.
Okay. Thank you. This is a PET approach.
Yeah.
Okay. Thank you.
Okay. So FCFE, we got 2866.508. Now the only thing is we know the cost of equity and also we know the growth rate. Now we can definitely get the value of equity is simply going to be FCFE. Value of equity will be FCFE for the year 1 upon KE minus G. So FCFE for year 1 is going to be FCFE for year 0 multiplied by 1 plus growth rate upon K is 9.81% minus growth rate of the number which we have 7%. Yes, so K minus G. We can say FE for year 0, which is 2866.51 into 1.07 upon 9.81% minus 7%. So that's 2866 into 1.07, and this is going to be 9.81% minus 7%. Essentially, the value of $1091.52. Okay, this is the value of the equity. Now, what will be the value of each of the equity shares? Value of one equity share. Value of one equity share will be this value divided by the number of equity shares. The count of number of equity shares, 380 crores. And so when we divide it, get the value of equity share as 287.24. Did you get it? Easy, guys? Yep. Are you getting it? Are you following, guys? How to get the FCFE? Yes. Okay. So now let's go for another question for valuation of equity, which is the question number 1. Question 1 from the revisionary session. Just have a quick look at the question. Following financial data are available for PQR for the financial year ending 2018. 8% debentures, 10% bonds, equity shares, reserves and surplus, total assets. If the asset turnover ratio, effective interest rate is given as 8%, effective tax rate is given, operating margins are given, dividend payout ratio is given, current market price of share is 14, and required rate of return on investors is 15%. You're required to draw income statement for the year, calculate its sustainable growth rate of earnings, calculate the fair price of company's share using dividend discount model, and what is your opinion on investment in the company's share at current price? Okay, so following financial data are available for EQR, and we have to prepare the income statement first. Then we have to get the sustainable growth rate and also fair price using the dividend discount model. Let's try to start with the income statement. Let me prepare the income statement. So in income statement, we definitely start with the sales figure. Okay, so well, the sales value will be calculated as the total assets, right, into the assets turnover ratio, which is 1.1. So since the assets turnover is 1.1, we can say it is 600 into 1.1. So sales is going to be 600 into 1.1, which is 660. Then remember, we have the operating margin to be 10%. So when we have the operating margin to be 10%, EBIT is going to be 10% of 660, which is 660 into 10%, that's 66. Can you tell me what will be the operating expense then? The value of operating expense.
594.
Can I say it's going to be the balancing figure? 60 minus 66, which is 594. Now from this EBIT, we are going to subtract the interest value. So interest is going to be 10% of the bond, which is 50. And is there any other loan or something that's payable? Interest, effective interest rate is 10%. Right, the effective interest rate is going to be 10%, and then we have like
8%, no, sir?
Sorry, effective interest rate is, my bad, 8%.
8%.
So since this is going to be 8%, what is the amount of interest going to be, and what is the total liabilities that we have? Effective interest rate, when we say 8%, it's going to be the percentage of the liabilities. So
14.
what is the amount of
14.
14?
Yeah.
How did you get the
Interest.
14? Because we have
debentures
interest,
plus bonds.
debentures plus bond
into
total.
8%.
So
Into
debentures plus bonds, on 185 you have 8%, and on 50 you have 10%. So let us say 125 into 8% plus 50 into 10%.
So दोनों पे 8 ही लगेंगे. दोनों पे 8 ही लगाएंगे ना. इफेक्टिव इंटरेस्ट रेट 8 है तो दोनों पे 8 ही लगाने हैं.
Effective interest rate is 8. Yeah, so effective rate will be दोनों पे going to be 8%. So since the effective interest rate is 8%, that rate will be applied for both. This is like 175 multiplied by 8%, which is 14. Then we have the profit before tax as 66 minus 14, which is 52.
Yeah.
Less tax. So tax rate is given to be 40%.
Yeah, yes, sir.
Tax rate is 40%. So on 52, you pay 40%, which is 20.8. Then we get the profit after tax figure to be 52 minus 20.8. Okay, so which is 31.2. And from this, we are paying a dividend. Dividend payout ratio is 16.67%. So dividend is 31.2 into 16.67%.
5.2.
Is into 16.67%. which is 5.2. 5.2. So what we have is retention ratio or retained earnings, which is 31.2 minus 5.2, which is 26. So we have prepared the income statement. The next part is calculating the sustainable growth rate. So how do we calculate the sustainable growth rate? Sustainable growth rate is, how do we calculate the sustainable growth rate? Can I say retention ratio into return on equity? The retention ratio, we know it is 1 minus 0.1666 multiplied by return on equity. Now, what's the return on equity? Return on equity is, have we computed the return on equity? We need to get it calculated separately. So let's talk of return on equity. So return on equity is simply going to be PAT upon net worth. PAT is 31.2 upon net worth of the company is simply going to be assets minus liabilities or just share capital plus reserves. The share capital plus reserves is 400. Is 300 plus 100. Right. So return on equity works out to be 31.2 divided by 400, which is 7.8%. So sustainable growth rate is into 7.8%. Sustainable growth rate will be 1 minus 0.166 multiplied by 7.8%, which is sustainable growth rate stands at 6.5%. That is done. Then fair price of the company's share using dividend discount model. And then what's your opinion on investment in the company's share at current price? You have to look at the fair price of the company's share using dividend discount model. So fair price using the dividend discount model is going to be E1 upon K minus G. Right? So E1 upon K minus G. So for that, I need to first get the value of dividend. Right? So we need to first get the value of dividend, and then of course the dividend needs to be divided it by K minus G. So we need to get the D1. So D1 is going to be computed as D0 into 1 plus G divided by K minus G. How do we get the dividend? D0. D0 will be simply, from here we can compute D0 as 5.2 divided by, what's the number of shares that we have? 10. So, which is 0.52. D0 is 0.52. So we get this as 0.52 into 1 plus a growth rate of 0. Divided by K is, what's the required return for investor is 15%. 0.15 minus 0.065. This is 0.52 into 1.065 divided by 0.15 minus 0.065. This 0.5538 divided by this, it is 6.51. 6.51 or 6.52 is the value of the share. Okay. Then the question says, calculate the fair price, or what's your opinion if in the company's current share price at the current level? So at the current level, share price is 14, whereas what we get is 6.52. Right? So what can we say about the price of the share? Is it overvalued or undervalued?
Overvalued.
Overvalued, right? So obviously the share price is overvalued in current scenario. Okay, so we have like done a few questions on cost of secure equity shares. Now let me go ahead with the another aspect, which is the bonds part, bond valuation, bond risk part. Okay, let us take up that portion now. First, let us discuss the concept about it. Then we'll do the questions based on that. We have like question 2 based on the bond. This one question is going to cover up most of the concepts that we have in the bonds chapter. Okay, just like equity shares, the bond value today is going to be present value of all future cash flows discounted at certain rate of return. So when you say value of the bond, it's going to be present value of future interest receipts plus present value of future redemption amount. Okay, so value of the bond will be present value of future interest receipts plus present value of the future redemption amount. So par value, now certain terms that we have in a bond is par value, which is the face value of the bond, coupon rate, which is the rate of interest to be received on a bond based on its par value. Frequency of a coupon can be annually, half yearly, quarterly, or monthly. Maturity time period will be the time period of redemption of the bond. Redemption value can be one final one-shot payment that you have at the end. For example, par value of the bond is 1,000. Coupon is 10%, maturity is 3 years, redemption is 1,000. YTM is the rate of return that you need, the rate of return which a investor required from the bond investment. That's given as 12%. We can definitely get the value of the bond by simply taking the present value of all the cash flows. So first we write down the cash flows, we take the PV factors, multiply the PV factors with the cash flows, and then come with the total of PVs. Okay, and then we come with the total of PVs. So 951.96, that's the value of the bond today. Or other way around, we can also write it like this by using the present value annuity factor. So by using present value annuity factor also, we can calculate the present value of this. Now, this is quite obvious that the rate of return that an investor will require on a particular bond, is it going to be equal throughout its life? Do you feel that as an investor, the rate of return that you will need from a bond, is it going to be equal throughout its life? Of course not. The rate of return which you need on the equity share or on the bonds is going to be dependent on many different factors. Right? It's going to be dependent on many different factors. So, for example, when you issued the bond, that time the repo rate was 6.5%. That time the repo rate was 6.5%. So then you expected a YTM of 8%. Right? So bond was having a rating of AAA. Now, when you go ahead with year 0.5, let's say half a year later, RBI has raised the repo rate. Okay, so suppose RBI has raised the repo rate from 6.5 to 6.75. So repo rate has increased by 0.25%. If you're saying that repo rate has increased by 0.25%, how much is the YTM going to be then? So if it is increased by 0.25%, of course, the YTM is not going to be remaining at 8%. It will increase by 0.25% to 8.25%, which is 0.25% increase. So here, your required rate of return on the bond has increased from 8 to 8.25%, not because the bond has changed its characteristic, but because of change in the external environment, and that external environment includes the repo rate. So repo rate has increased from 6.5 to 6.75, which means YTM has changed from 8% to 8.25%. So there is an increase of 0.25%, right? Okay, then by the end of another half year, that is by the end of, let's say, first year, what we typically find is that the repo has not changed, but the rating of the bond has fallen. Now, when you say the rating of the bond has fallen, it simply means that the rating has not fallen, but then that essentially meaning that YTM will definitely increase because the risk of the bond has increased. When the rating of the bond decreases, risk of the bond increases, and that's where we say the YTM is also going to increase. So changes in YTM are going to happen due to multiple reasons. One would be external, another would be internal. External would be like changes in any repo rate, changes in macroeconomic situation. And internal would be like the changes in the rating of the bonds. Right? So one typical relation that we observe is as the YTM increases, the bond value is going to decrease. So there's always an inverse relationship between the YTM and the bond value. Okay, so when you take the present value of it, you'll find that the bond value and YTM are having a inverse relation with each other. We have observed that we can calculate the YTM of the bond by simply doing the same calculation as we did for IRR. Okay. Then coming to another concept where we say the relation between YTM and the coupon. If the coupon is more than YTM, so bond is essentially giving you a return more than bond is giving you a return more than what you would require. So bond is giving you coupon more than a YTM, so it's going to trade at a premium. If both of them are equal, then it's going to be trading at par. And if your YTM is more, whereas your discount, and if your coupon is lower, then the bond is going to trade at a discount. Okay, and the bond is going to trade at a discount. Okay. Now, one very important characteristics that we have observed is understanding something called as modified duration and Macaulay duration and then modified duration. So we have observed that Macaulay duration is simply weighted average of time period of investment in a bond, right? So when you have the year and the cash flows given to us, you calculate the YTM of the bond. At the YTM of the bond, you get the value as 112. And then when we want to calculate weighted average of time, so weighted average is definitely computed as summation of W into X divided by summation of W. So weighted average is computed as summation of W into X divided by summation of W. So weightage is going to be this particular numbers, which is essentially computed as present value of that particular cash flow divided by the total present value. And then weighted average is going to be weights into T, which is time period. So we want to compute the weighted average of time. We want to compute the weighted average of time. So we take the present value to be the weightage. And then we do weightage into time. We get it as 4.51. So 4.51 is the weighted average time period of the investment. So 4.51 is a weighted average time period of the investment, which means on an average, my money is blocked in the bond for 4.51 years, right? This is definitely going to be used when we are looking for bond immunization. But one important derivation or number that we need to have is a modified duration number. Modified duration is the expected percentage change in bond value due to 1% change in the YTM. So modified duration is expected percentage change in bond value due to 1% change in the YTM. So modified duration is Macaulay duration upon 1 plus YTM. Macaulay duration is 4.51 upon 1 plus YTM, which is 1.05. So Macaulay duration is 4.51 divided by 1.05. That's your modified duration calculation. Now, when we say modified duration is 4.5, it essentially means that for 1% change in YTM, there's going to be 4.3% change in the bond value, right? But this relation truly is not going to be applicable because when you're calculating the modified duration, you're essentially drawing a tangent to the curve. There is always this gap between the actual bond price and the bond price estimated using the modified duration. So there's this gap, and that gap is essentially filled by the concept called as the convexity or the bond convexity. right? So when you take into account the bond convexity is computed by adding one more column, which is present value into t plus 1. And then you obtain the convexity as sum of present value into t plus 1 upon bond value into 1 plus ytm square. So convexity value is 23.71, right? So convexity value is 23.71. And this convexity term is going to be added as a plug figure. You add this convexity adjustment to get the improved expected change in the bond value. And that expected change is going to be very much closer to the actual bond value. Okay. So that's how we compute the convexity and adjust it into the estimation part. Now coming to the question number 2, where Mr. A will need 1 lakh after 2 years, for which he wants to make one-time necessary investment now. He has a choice of 2 types of bonds, right? So for the 2 types of bonds, you have like 1 year to maturity and 4 years. So there are 2 bonds in which we need to compute the first. I want you guys to compute modified duration for both bond X and bond Y by simply taking this example as a reference. Take this example as a reference and try to get the Macaulay duration for both bond X and Y, guys. Try to get the Macaulay duration for both bond X and Y. Hmm. Try to get the Macaulay duration for both bond X and Y from this question, guys, for both bond X and Y. You need to write down the year, the cash flows, PV factors, take the PV, and then consider the weightage arrived from the PV values. Then you take the weightage into T. Yep. What's the Macaulay duration for the first bond, which is 1 year to maturity? Macaulay duration for the first bond, which is having a maturity of 1 year. Yeah, it's going to be just 1 year. When we're computing Macaulay duration, we have just one cash flow from that bond, which is 1070, right? Present value factor is 0.9090. We take the present value to be 972. And when we take the weightage is just 1 year. So weights into 2 is 1. But for the bond Y, you take the present value factors, multiply cash flow with present value factors, take the PV, and then PV will be converted to weightage. Then you do weightage into the time period. Right? So weightage into time period, we get it as 3.562. Just verify, guys, are we getting this Macaulay duration? Because it's a very basic thing that we need to have. Did you get this Macaulay duration numbers? Did you get this Macaulay duration numbers? Yes. We're getting these Macaulay duration numbers, guys.
Yes, 3.56.
3.56. Now coming to this concept of bond immunization. Now, bond immunization is a technique wherein we are going to create a portfolio of bond which will ensure that my bond value is going to ensure that my bond value is typically going to be constant, even if the market rate of interest increase or decrease. Because what we can observe is the money that we are going to receive in between, there is always a reinvestment risk. So if I'm going to invest in a bond for a tenure of 5 years, or for, let's say, for example, for a tenure of 2 years, and if the reinvestment rate is changing, my maturity value or the realization value also changes. So in such situation, we try to create a portfolio of bond which will be providing me with immunity for the bond value irrespective of the change in the bond. So that portfolio, or that particular immunized bond portfolio, is simply computed by investing in a portfolio which will comprise of a bond with a tenure lesser than your required time period and bond with a tenure more than the required time period. So we take like bond X with a duration of 1, bond Y with a duration of 3.562, bond X with a duration of 1, bond Y with a duration of 3.562. So over here, bond X is given a weightage of X, bond Y is given a weightage of 1 minus X. So weightage of X into duration of X plus weightage of Y into duration of Y. So X into 1 plus 1 minus X into 3.562, that is equal to 2. Okay, so weightage of investment in bond X is 0.61. Weightage of investment in bond Y is 0.39, which we obtain it by simply solving this. Then once we have arrived at these values, we calculate the value of investment to be made today in bond X and value of investment made in bond Y. And accordingly, we calculate the value of the bonds. And what we observe finally is when the YTM changes to 9%. So let's say YTM changed to 9% from current level of 10%. So let's say YTM has reduced. So if YTM has reduced, so whatever cash flow you are getting in between, you can reinvest it at 9%, which is at a lower rate. So year 1070 is what you're going to receive, and you're going to reinvest it at 9%, which is finally going to mature at 1166 in total. And the total cash flow from bond X will be this multiplied by the number of bonds. Then cash flow from bond Y, year 1 it is 80. Coupon on one bond will be reinvested for 1 year at 9%. Coupon on one bond is going to be reinvested for 1 year at 9%. So 80 is going to be reinvested at 9%, which will mature to 87.2. But in year 2, when I'm going to sell this bond, in the second year, when I'm trying to sell this bond, I'll be able to sell this bond at a lower value. be able to sell this bond at a lower value. So this is going to be because, I'm sorry, not a lower value, but at a different value, because now the rate of interest has changed. So you calculate the value of the bond in second year. In second year, now the bond has become actually a 2-year bond. I mean, a bond which was a 4-year bond 2 years before, now it is just a 2-year bond. So we calculate the value of this bond to be 981.41. When we add both of them for one bond, this is the cash flow. So in total, we have taken 34.41 bond, which is 39.558. The total cash flow from all bonds is what we observe, 60,446 plus 39,558. So irrespective of bond value, I mean, YTM changing to 9%, YTM reducing to 9%, you find that bond is having a maturity of 1 lakh. Right? So your requirement of getting 1 lakh is definitely fulfilled over here. Right? So same will happen even if the YTM changes from, instead of changing to 9%, even if it reduces to 8%, or if the YTM increases to 11 or 12%, it's just going to be one and the same. Okay, so this is what we have, the concept of bond immunization, where we are creating a portfolio of bond which is having a immunity, which is having the the definite maturity value. Okay, that's question number 2 for us. Question number 5 is done. Then question 4, Bank A enters into repo for 14 days for Government of India bonds at 5.65% for 8 crores, right? So this is a repo transaction. So for that, let's try to understand first what is a repo transaction. Yeah. So what happens in a repo transaction is that RBI is going to give you money against the government securities with an agreement by the banker that banker is going to buy back this security at some price on a future date. So there it's like, a bond is given and a repurchase price is fixed, which is going to be higher. So the difference between the sale price and repurchase price is basically the profit or income that you get. So in this case, there's a clean price of 99.42. We need to get the total price. The total price can be computed by adding the accrued interest. So clean price is 99.42 plus accrued interest of 7.28. Total or dirty price is 106.7. Nominal value of the repo is 8 crores. So the amount that I'm going to get against repo, since it's a nominal value, 8 crore for nominal value of 100 into 106.7, this is the value of receipt that you get. But of course, since there's a margin of 3%, we are going to subtract, or let's say that there's a margin of 2%. So we are going to subtract that proceed from here. I mean, the margin will be subtracted and you get the margin value, right? After margin value, this is amount what you're receiving. Now, interest that is payable is on this amount 5.65% for 14 days. And then repayment will happen as the amount received plus the interest payable under the repo. Okay, so that's the repayment amount which we have for the second leg of transaction. Okay, so repo is basically repurchase, where the securities are sold first and then they are going to be repurchased at a higher price. And the difference is going to indicate the amount of return or profit that is generated. Okay, so with this, we have completed like the revision for the topic of security valuation, right? So let's just take a break right now, guys. Break of around 15 minutes, and then we'll come back and start with the concepts of portfolio management. Okay, let's take a break, guys. Okay, welcome back, guys. We'll start with the recap for portfolio management. Getting certain concepts clear today, and then later on in the upcoming sessions, we'll be taking up quite a good number of problems for discussing the same. Okay, let's talk about portfolio management. The core of finance, the hardcore thing that we do about finance is simply undertaking the valuation, just like we did in the previous question, the valuation of previous topic, which is security valuation. So we know value of an asset is simply going to be present value of all future cash flow, right? So the present value of all future cash flows. So what we essentially do is value of an asset is cash flow in first year upon 1 plus rate plus cash flow in second year upon 1 plus rate square plus cash flow in third year upon 1 plus rate raised to 3 and so on till goes on till perpetuity, right? So the point is, what should be this rate of discounting? Right? So this rate of discounting essentially depends on the risk. Depends on the risk. Okay, so which simply means higher risk is definitely going to require higher rate of return. R is basically something that depends on the risk. So higher risk leads to higher rate of return. Okay. So R is the rate of return, right? R is the rate of return, which depends on the amount of risk that is involved in the investment. So higher risk requires higher rate of return. Now the question arises, now how to measure risk? That's the first part which we have, which is how are we really going to measure the risk? And also for a given level of risk, what should be for a given level of risk, what should be the rate of discounting, or what should be the rate of return? Okay. How are we going to measure risk? That is one thing. And then the other is for a given level of risk, what should be the rate of discounting? Right. So this is something that the portfolio management as a topic tries to address, right? And also we are going to have an understanding of how to create a portfolio which is efficient. Now, when you say portfolio, so we are looking at creation of portfolio such that the portfolio is giving us the highest possible return and also trying to minimize the risk. Okay, so we are trying to get the highest possible return at the lowest possible risk. Okay, so now first we need to understand how are we going to measure the returns. Now to measure the returns, let us simply look at let's say let's say a particular share, right? And that share is having its prices, right? So year 0, 1, 2, 3, 4, say 4 years. So initially it had a price of 53, then it increased to 60, then 65, then 72, and then it has reached to 80. So these are the prices. And then we have the dividend amount. So dividend in first year is 2 rupees, then 3, then 1, and then 4. These are the dividends. Can we calculate the returns? Can we calculate the returns here? Right? Can we calculate the returns by looking at these numbers for the past 4 years? We want to calculate the returns for the past 4 years. What's the return? Can we calculate the return for the past 4 years? Yes, guys? How do we get the returns for year 1, 2, and 3? Year 1, 2, 3, and 4? How do we calculate the returns for years 1, 2, 3, and 4? Yep. How are we going to calculate the returns for these years 1, 2, 3, 4? Yeah, so we can calculate return by simply taking price in year 1 minus price in year 0 plus dividend that you are receiving divided by P0. So return over here is nil. Then this return will be computed as 60 minus 53 plus 2, the whole divided by 53. What's the return percentage guys for the first year? Tell me. What's the percentage rate of return? 60 minus 53 plus 2, the whole divided by 53. What's the rate of return?
16.98.
16.98. Okay. Same way, give me the return for the remaining 3 years.
13.32.
13.32. Okay. Then
12.31.
12.31%.
31.
Then
16.67.
16.67. Okay. So these are the returns that we have, right? We have computed the rate of return based on the past data. So return calculation is pretty easy. Now the next step is to calculate the risk that is involved in this. Now we find that returns over here are not constant like government security. It's not like government security that the rate of returns throughout the 4 years are one and the same. All the returns are not same. They are fluctuating. So one very primitive and a simple way to understand the risk that we have in a particular investment is to look for variability or dispersion or deviations in the returns. Risk is going to be computed. Risk is going to be the degree of variation or dispersion. So risk is basically the degree of variation or dispersion in returns. The degree of variation or dispersion in returns is what we call as a risk. Now, how do we measure this degree of variation or dispersion? By calculating standard deviation. Okay. So let's say year and return numbers we have. We've got, let's say, 5 years. And the returns are like 10%, 8%, 12%, 14%. And then this is 10%. So these are the returns that we have. We want to understand the variation that we have in this returns, right? What are the variations that we have now? So for that, let us first calculate the average return. What is the degree of average return? What is the degree of average return? Average return can be simply take the total of it and then divide it by a number of years, which is 5. So tell me what's the average return here?
1.8.
Total of these returns is how much? 18 plus 20.
54.
54%. So average return will be 54% divided by 5, which is
1.8.
huh? 54 divided by 5. 10.8, right? Correct? 10.8% is the average return that we have. Now, I want to know the dispersion in this rate of returns. When you want to check what is the degree of rate of returns, we are going to look at the deviation. So, deviations is basically going to be, if I take this returns as values of x, so first let us take the deviation as x minus x bar, which is the average return, x minus x bar. So, we are looking at the deviation. So, just calculate the deviation and give me the total of this. Calculate the deviation and give me the total of all the deviations. Calculate the deviations and give me the total of all the deviations.
Zero.
Total is 0?
Yes.
Yeah. Total is 0. So does it mean that this is going to be like a 0 deviation? I mean, there's no deviation in it. Does it mean that there is a 0 deviation?
No.
No, of course, there is some sort of deviation, right? So that deviation, can you just help me with the numbers of deviation here? And the number of deviation, I mean, amount over here. So 10 minus 10.8, that's minus 0.8%. Then next one.
Minus 2.8. Hello. Minus 2.8.
Minus 2.8. Okay.
1.2 plus 5.
Minus 2.8. Then
1.2.
1.2.
Yes.
Okay.
3.2.
Then 3.2%. Then
minus 0.2.
0. Minus 0. So when you're having the deviations per total, you're saying that deviations in total is 0. Right? So deviation totaling is 0, which essentially, which we cannot definitely conclude that there is no deviation. Why are these total of deviations coming out to be 0? For a simple reason, guys. The simple reason is the total of deviations are simply 0 for a very simple reason, because there are certain deviations which are positive and certain deviations which are negative. And because of this, certain deviations which are positive, certain deviations which are negative, because of this, what we find is that they're canceling out each other. So I cannot just take plain deviations to be a measure of risk. Rather, what we need to do is to remove this negative nature. We're just going to take the square of it. We're going to take a square of it. So let's take a square of each one of them. So minus 0.8% square. Minus 0.8% square.
0.64.
0.64. Then 2.8 square.
7.2. 7.84.
7.84. 1.2 square.
1.44.
3.2 square.
10.24.
7.44.
Yeah. No, 10.24.
10.24. Then 0.8 will be 0.64.
61.
So total of these squared deviations, how much is it? Total of the squared deviations.
20.8.
20.8. Total of squared deviations is 20.8. So when we take average squared deviations, so average squared deviations is simply going to be summation of x minus x bar square upon n, which is 20.8 divided by 5. How much is
4.16.
20.8 divided by 5?
4.16.
4.16. Average square deviations is 4.16. Right? So this average square deviations, I cannot take this as a measure of dispersion. Why? Why can't I take this 4.16 as a measure of dispersion? You guys tell me. Why can't I take this as a measure of dispersion? Because these numbers are squared terms. These are like magnified deviations. These are like magnified deviations. And of course, magnified deviations can't be a replica for the risk that you have. So how do I make it, or how do I bring it back to original deviation part?
Square root.
Square root, right? Okay, by the way, this 4.16 is said to be variance and denoted by sigma square. And then we have like standard deviation is denoted by sigma as root of 4.16. What's the square root of 4.16?
2.04.
2.04. That's the standard deviation number. So that's the deviation that we're talking about. 2.04 is a measure of standard deviation, or it's a measure of risk. Now, how do we really interpret this risk? The risk is like, 10.8% is the average return, and it is likely to fluctuate by 2.04%. It means 10.8% can increase by 2.04%, or it can decrease by 2.04%. Okay, it can increase by 2.04%, or it can decrease by 2.04%. Very clear? Yeah, guys. So that's how we compute the standard deviation, variance, and the standard deviation for a particular data. Now, this standard deviation can also be computed from a different angle. The first angle that we did was looking at the historical returns. You look at the historical prices. Based on those historical prices, you compute the return, and then based on the returns, you compute the standard deviation. There's another way of computing this standard deviation by looking forward or looking for probability numbers. So we have like probability. Let's say the current market price is rupees 80, and then we have probability and the price. Right, so we say there is a 10% chance that the price may be 70. There's a 20% chance that the price may be 85. There's again 20% chance that the price may be 95. There is again 10% chance that the price may be 105. And there is a 30% chance or 0.3 chance that you'll have the share price as 110, and another 0.1 chance that the share price will be 120. Can you calculate the returns over here? Calculate the possible returns, guys. For each of these prices, what will be the likely returns? Returns. Calculate the returns for each of these prices, guys.
7. 7.
So return is 70 minus 80 divided by 80. How much is this? Minus 12.5%.
Yes.
Then we have 85 minus 80 divided by 80. Yep.
6.25.
6.25%. Okay. Same way, give me the numbers for other values.
18.75.
18.75%.
20.
20%.
20 की जगह 31.25 आएगा.
This is 31.25.
Yes.
Okay. Then the next price.
37.5.
37.5%. Okay. Then
50%.
50%.
50.
50%.
50.
Yeah, 50.
50%. So these are the likely returns from a particular stock. Now, how do I calculate the variation in these returns? These are not the returns of the past, by the way, guys. These are not the returns happened in first year, second year, third year, like that. No. These are the likely returns for the next year with these chances, with these probabilities. These
By
are the likely
multiplying
returns.
probability.
Sorry.
By multiplying probability and
Yes.
sum
So
of.
first we need to get the expected return, or which is also what we call as average return. So average return is going to be simply summation of probability into x. We do probability into x and then take a total. Give me this number, guys. Multiply probability with x and get the total.
$25.625.
25.625 is the expected value. 25.625. Now, how do I calculate the deviation over here? So first, to calculate the deviation, we'll definitely take x minus x bar, and we know x minus x bar, when we take a total, it's obviously going to be 0. So we take a square of it, right? So we take a square of it, but we're not going to take a total of this because I need to multiply further this with the probability, right? So essentially, it's going to be probability into x minus x bar the whole square. So calculate this probability into x minus x bar the whole square. get the total of probability into x minus x bar the whole square.
Two zero 6.64.
Total is 206.62.
64.
64.
Yeah.
Okay. So now what will be the variance? This is what we have got the variance. Variance is 206.64. What about the standard deviation? Standard deviation will be 206.64 square root of 206.64. Yeah. What is this number? Standard deviation 206.64.
14.37.
14.37%. Right. So we're saying that the returns is expected to be 25.625, but it is likely to fluctuate upside 14.37 and downside 14.37. Correct? Yeah.
So का एक्सेल डाउन करेंगे.
Sorry.
स्क्रीनशॉट लेना है पूरे का. एक स्क्रीनशॉट लेना है पूरे का.
इसका. Is it okay? This one?
Yeah. Yes.
Yeah. Done? Okay. We're done, guys? Okay. Now, let us just take it forward for risk for two securities. So we have seen how to calculate standard deviation, how to calculate returns for single security. Now let me just take it forward for risk of two securities. For a moment, guys. We have covered. This is covered. This is done. Now, when we are having two securities together, year 1, 2, 3, 4, 5, we have the returns given to us for both x and y. So we calculate the standard deviation just like the previous way. The historical, we calculate like x square, y square. The return, we take average to be 8.4 and 9.8. Risk is going to be square root of, by the way, one more thing I just forgot over here, that we can calculate standard deviation by using, like the standard deviation formula was square root of summation x minus x bar square upon n. You can also calculate the standard deviation by another formula, summation x square upon n minus x bar square. Both the formulas are going to give you similar answer. Both the formulas are also going to give you the similar answer. Okay. And even for this part, it's just the same thing. The standard deviation is square root of summation p into x minus x bar square, or you can also have it as summation px square minus summation px the whole square. Now, I just want you to check if we use this particular formula. So, for example, let's say take this data, and for that, so these are the returns given to us. Just take the x square, take a total of it, and see what's the value for summation x square upon n minus x bar square. Just check what is the value coming out to be. Just verify. If we take the square of it, take a total. See what's the value that you're getting. Take the square total and then substitute in this formula.
604.
What is x square total is 604. Okay, substitute and see whether the standard deviation is same as 2.04. Verify, guys. You're getting the same number. It should be like 604 upon 5 minus 54 square, and then taking the root of it.
X bar का square है?
Sorry, x bar, yeah. X bar was how much? 10.8, right? Right? Are we getting the same answer? 104 divided by 5, 120. Yeah, it's coming out
120.8.
And
Same answer.
same answer, right? So either of these we can use the formula. So here we have used that formula. Taking x square, y square, we calculate the standard deviation of both x and y, right? Now, when we calculate the portfolio return, so let's say we have these particular numbers where the expected returns are 8.4 and 9.8%, risk is 8.26 and 3.87. If you're creating a portfolio, comprising of, let's say, 60% of security X and 40% of security Y. If we have these two securities comprised in a portfolio, so the return that we could expect from the portfolio will be 60% of return of X plus 40% of return of Y. Okay, 60% of return of X plus 40% of return of Y. So you can calculate the portfolio return to be simply weighted average of this, which is 8.96. Another way of looking at it is, suppose if you would have created this portfolio 5 years ago with the same weightage, this portfolio would have given you returns of 12.4 in the first year, 13.4 in the second year, 10.6 in the third year, 3.6 negative the fourth year, and 12 in the fifth year. And then when you calculate the average of this average of historical portfolio return, that is 8.96. So historical portfolio return average and a weighted average of portfolio returns are exactly matching with each other. Okay. But when we try the same thing for standard deviation, that actually doesn't work. Because if I just take a weighted average of the standard deviation, which is weight of x into standard deviation of x plus weight of y into standard deviation of y, right? That is not going to be equal in both the situations. Because if I take historical proportion, if I calculate the value of portfolio and standard deviation of portfolio using historical portfolio return with the weighted average, this doesn't work. So this one, just a weighted average number is incorrect. Rather, what we'll have to do is we'll have to use a different method for calculating the portfolio return, which is this particular formula given by Harry Markowitz for the modern portfolio. The formula stands as weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y into correlation between x and y. Okay. Weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, and correlation between x and y. Now, suppose if I'm giving you numbers, like if I'm giving you, let's say, correlation. Okay. Suppose I'm giving you the correlation. Let's say there are two securities, X, Y. With their return being 10%, 12%. Return being equal to 10%, 12%. Standard deviation is 20%, 23%, and we say the correlation between them is 0.5, and let's say weightage is 0.3, and 0.7. What will be the portfolio return, guys? What will be the number of portfolio return? How do we calculate the portfolio return? Portfolio return will be computed as weight of x into return of x plus weight of y into return of y. The weight of x is 0.3 into return of x is 10% plus
11.4.
Weight is 0.7 into
12%.
12%. So how much is this?
Yeah. 11.4.
11.4%. Now calculate the portfolio risk over here. Calculate the portfolio risk. The portfolio risk will be square root of weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, and correlation between x and y. Substitute values over here and get the portfolio risk price. Give me the portfolio risk, guys.
Three 3.92%.
3 point?
Sorry.
0.92.
No, sir. 1.9794.
1.9794
1.9794.
going to be square root of 0.3 square into 20 square plus 0.7 square into 23 square plus 2 into 0.3 into 0.7 into 20 into 23. How much is this?
Yeah. आपने स्टैंडर्ड डिविएशन को भी परसेंटेज में लिखना है ना 0.2.
No, keep it in normal numbers. Because otherwise it will go into decimals. Just recalculate it and see what's the portfolio risk. What's the portfolio risk?
ये लास्ट में आपने 0.5 नहीं लगाया.
R. Sorry. R will be multiplied here. 0.5 will be multiplied in the last.
$19.79.
19.79. 78. Are you sure?
9.
Are we getting this 19.78, everyone? $19.78. Just check. Is square root of 0.3 square multiplied by 20 square plus 0.7 square multiplied by 23 square plus 2 into 0.3 into 0.7 into
20.
20 into 23 into 0.5. 19.79. Absolutely correct. Okay. So can you tell something surprising over here? Look at all standard deviation numbers. Can you tell me what is surprising over here? Can you just look at all standard deviation numbers and tell me what is the most surprising over here? The surprising part is X is having 20%, Y is having 23%. If you combine both of them and create a portfolio, ideally the risk should be in between 20 and 23. But it's not between 20 and 23. Rather, it is falling even below 20. That's what we call as portfolio diversification benefit. They're having the benefit of portfolio diversification as 19.78% being the portfolio risk, right? So when you create a portfolio comprising of two securities in which they are going to be connected with each other, we find that the portfolio risk actually reduces below a particular level. For example, take a case of this case. Suppose we have two securities A and B with standard deviations 10% and 13%, returns being 12% and 14%. So correlation is 0.2. Right? So standard deviation of portfolio, when I apply the formula along with the return formula, we get these many values. Right? Just look at the pattern of standard deviation. So when you were fully invested in A, you are having the risk return profile exactly as A, which is obviously not at all surprising. But when you combine a bit of B into your portfolio, combining a bit of B into your portfolio, standard deviation of portfolio works out to be 9.35. Standard deviation of portfolio works out to be 9.35. Right? So the standard deviation of portfolio is actually reducing. Rather, it keeps on reducing up to this fifth portfolio, which is having a weightage of 0.659 and 0.341. Where the lowest standard deviation is observed, which is 8.65%. Right? And you're observing that since it is 8.65%, since it is reducing to 8.65%, what we have to look at over here is the standard deviation reduced to 8.65% over here. That's the lowest possible standard deviation, and beyond that, it again starts rising. So it means it's not always that when you're going to combine one portfolio, one security with another, your portfolio risk is going to fall. Portfolio risk will fall only to certain extent. Beyond that, it's going to be a constant term. Right? So beyond that, it's going to be a constant term, which is it's not constant, sir. Beyond that, it's going to start increasing. Okay. And we find the return of portfolio to be of this nature. Now, the lowest risk is at this corner point, at this edge. Right? So, lowest risk of the portfolio is at this edge, and this can be actually computed by simply looking at minimum variance or risk portfolio weights. Minimum variance or minimum risk portfolio. This can be computed by using the formula over here, as you can see. So weightage of A will be standard deviation of B square minus correlation between A and B into standard deviation A into standard deviation B on standard deviation of A square plus standard deviation of B square minus 2 into correlation between A and B multiplied by standard deviation of A into standard deviation of B, which we obviously found it to be 0.659. Okay. Now, based on this, I'm just giving you one question to practice over here. You can see this space. Just giving you this question. Let's say there are two securities A and B. They have got their returns 13% and 17%. Standard deviation is 18% and 20%. And correlation between both of them is 0.2. Okay, and weightage being 0.6 and 0.4. Weightage being 0.6 and 0.4. Calculate weightage of A for minimum risk and calculate weightage of A for minimum risk and corresponding portfolio return and risk. Just use this particular formula and try to calculate the weightage for a minimum risk, and at that weightage, what is the portfolio return and what is the portfolio risk? That's what I want you to calculate, right? Yeah, calculate the weightage of A, right? And then return of portfolio. Return of portfolio, and also give me the standard deviation of the portfolio. Calculate the weightage of A, return of portfolio at these rates, and also standard deviation at these rates. Yes, able to get the weightage? Just use this formula, guys. Minimum variance or risk portfolio. Use this formula to get the weightage of A, and based on that weightage, you can actually get based on the weightage, you can get the return of portfolio and standard deviation of portfolio. Yeah. What is the return of, weightage of A? Just use this formula. Standard deviation of B square minus correlation between A and B into standard deviation of A, standard deviation of B, the whole divided by standard deviation of A square plus standard deviation of B square minus 2 into correlation into both the standard deviations. What's the weightage? Are you getting it? I'll solve it for you. It's going to be standard deviation of B square, which is 20 square, minus correlation is 0.2 into standard deviation of A, standard deviation of B, which is 18 and 20, the whole divided by standard deviation of A square is 18 square plus B square is 20 square minus 2 into correlation is 0.2 into both the standard deviation 18 and 20. So you can just solve it and give me the number. What is this number? 20 square minus 0.2 into 18 into 20. And then divide by 18 square plus 20 square minus 2 into 0.2 into 18 into 20. What is this number? It should be 20 square minus 0.2 into 18 into 20. Then divide it by 18 square plus 20 square minus 2 into 18 into 20. Square plus 20 square minus 2 into 18 into this will work out to be 328 divided by 580, right? So that is 0.56552. So 0.56552 is the weightage of A. Corresponding weightage of will be 1 minus 0.56552. Return of portfolio will be simply weightage of A multiplied by return of A plus weightage of B multiplied by return of. Standard deviation of portfolio, we can simply arrive at by using that Markowitz formula of square root thing. That's going to be square root of rate of A square into standard deviation of A square plus rate of B square into standard deviation of B square plus 2 into rate of A into weight of B into standard deviation of A into standard deviation of B into correlation between two. So standard deviation of the portfolio stands as 14.67%. Standard deviation of B is 14.7%. Okay, standard deviation of B is 14.67%, guys. So the chart that we observed over here, right, this is what we have observed, that it's going to be curvature. So curvature is going to be like this is the corner point, and corner point can be obtained by using this particular formula. Okay. Now, what if we want to test it for different degrees of correlation? This is what exactly the chart will look like. You have the correlation value equal to 1, there won't be any diversification, rather the portfolio risk and return both will increase. But as the correlation reduces, the chart also shifts towards the left. And when your correlation is exactly -1, you can actually create a portfolio that is almost or near zero risk. No risk portfolio can be created by combining the respective and appropriate weightage of both securities. Okay, you can combine and create a portfolio comprising of both weightage, both securities with proper calibration that the portfolio risk can be minimized to zero. Okay. Now, one important part is, this is what we have covered till now, but I would just like to draw your attention towards another type of formula which we can think of. Like, see, we say that the standard deviation of portfolio is square root of weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y standard deviation of x, standard deviation of y, and correlation between x and y. This entire portion, which is standard deviation of x into standard deviation of y, right? Standard deviation of x into standard deviation of y into correlation between x and y. This entire term can actually be said to be covariance between x and y. Can actually be said to be covariance between x and y, right? Because correlation is computed as covariance between x and y upon standard deviation of x, standard deviation of y. Okay, so this essentially means covariance between x and y should be equal to r into standard deviation of x, standard deviation of y. Essentially, this standard deviation of portfolio, I can write it as square root of weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y into covariance between x and y. Right? So that's the covariance between x and y. Then minimum standard deviation weightage of x, minimum standard deviation weightage of x, we calculate its value as standard deviation of y square minus r into standard deviation of x, standard deviation of y, the whole divided by standard deviation of x square plus standard deviation of y square minus 2 into r into standard deviation of x, standard deviation of y. Right? Now, but obvious we can call out these terms to be covariance between x and y. So this essentially becomes standard deviation of y square minus correlation into standard deviation of x, standard deviation of y, the whole divided by standard deviation of x square plus standard deviation of y square minus 2 into this entire term, since we can say it is covariance between x and y. Right? So the formula can be rewritten by replacing correlation into standard deviation of x, standard deviation of y with covariance between x and y. Okay. Very good, everyone. So that's the formula for minimum standard deviation and also standard deviation portfolio. When it hasn't given you the correlation value, but they have given you the value of covariance. When you have the value of covariance, this is how we can simply compute the values of standard deviation of portfolio and minimum standard deviation weightage. Okay. Right. So we have just revised this particular formula. Then we have done next concept which I wanted to do, but minimum risk portfolio is the particular formula that we have already covered. Yes, there's an efficiency and inefficient portfolio, inefficient portfolio. We'll discuss about them in the next upcoming sessions. But right now, I just open it up to you. So if you guys have any queries, you can just ask to me. You can ask the queries if you have any for the today's session, as well as any past session that we have covered.
Yes, student, if you have any query relating to even examination, I'm here to answer that. Okay, student. Now, since assignment of the same topic, that is portfolio management, will be discussed in the next class. So it will be uploaded today itself, I say in 1 or 2 hours. Okay, and so it will, and Bandhuji will take this all the questions of the assignment in the next session. So student, if you have any query, even after the class, you are free to ask us. Bandhuji, just share our email ID as well as our phone number.
Ashish sir,
Yes, yes.
sir, please provide security valuation notes.
Yeah, but
Which
actually,
was last
we
class.
are in the process of converting them. Okay, it will take some time. Wait for 1 or 2 days. We will get it uploaded. Okay,
Okay, sir.
solutions will be uploaded. Okay.
Okay, sir. Thank you.
Good. So this is our phone number. That is 0120. That is Noida STD code, and the phone number is 3045956. Or you can send the email at uh, sfm-final@ica.in. Okay, so of course you can also send your query through the mobile app as well. So student, as I told you in the beginning, if any of your relative or your friend who is in just entering into the CA course, so there is a good golden opportunity for her or for him to connect with ICAI through our induction program that is scheduled for tomorrow, okay, at 10 a.m. in the morning through Zoom link. So every detail is available on our website. Through QR code they can get to connected with us. Okay, student, thank you very much. Have a nice day. Thank you. Okay, thank you, Bandhuji. Thanks a lot.
Thank you, sir.
Just wait for 2 minutes. Recording बंद कर दीजिए.
Recording stopped.